we are longer term investors, so we're always looking to not chase the market and the trends that are happening right now, but to see what longer term effects we can get out of what's happening currently. And for us, when you look at a reopening trade, you're right. We don't want to focus on the really highly volatile names, the names like Pelotons or Zooms or some of the retail names, even though we anticipate we're going to see probably a quick pop in some of those names as inventories are rebuilt, as people go out and update their wardrobe as they go back to work and for summer. But like you mentioned, all of these things have to be paid for, and the transactions are happening more and more online. We don't think that's going to change post-pandemic. People are going to continue those buying habits online. Their balance sheets, consumer balance sheets, are in really good shape right now, and they can take on more credit. So we think MasterCard or Visa is a great way to participate in the reopening trade without participating in some of the volatility of those pure reopening trade names.
I did not hear you throw out American Express or Discover. They have credit cards too, Victoria, or do MasterCard and Visa with their back end, with their programs, are they simply better bets for your clients?
That's exactly it. It's the business model for MasterCard and Visa. Transactions kind of started and finished there within their network, and they don't have as much exposure to business. Obviously, over the last 12, 18 months, we haven't seen the business travel there, and so American Express is taking quite a hit. You look at someone like Capital One, where they're really more focused and have more exposure to loans to consumers. We think MasterCard and Visa have a better business model, and their market share in the credit card company is huge. So for our investors longer term, we think those are your best bets in that space.
Okay, we like that as well. Hey, Victoria, I know you go on, Fast Money and Halftime. Can I ask you a viewer question, which we never do, but it's probably better than any question I can ask you? Thank you to the viewer, by the way. He's up nice and early or late, depending where they are. Do you think it's time to start moving assets now ahead of inflation? And I ask that from the viewer because I know you have kind of a contradictory view than most on inflation and interest rates.
Yeah, we side with the Fed that most of the inflation we're seeing right now is transitory. Obviously, we have base effects, we have supply chain issues. We heard Elon talking about all the supply issues and what Washington is doing to address that. But we think that we're going to see some of this inflation actually start to be longer term, and all of that comes from wage pressure. We saw in the last ISM, both US and global PMIs, that companies are saying they're having a really hard time filling these labor positions. And that's what the Fed is focusing on. We're seeing companies pay more with signing bonuses. They're seeing wages move higher in the labor report, even though it's the lower paying jobs that are coming back online. So it tells you wage pressure is there, and that should start to hand off. When it does, then we're concerned with inflation. But for now, we don't think the Fed is going anywhere. We think it's at least next year before we see them start to taper QE, and longer than that before we see any movement in rates.
Shepard Smith here. Thanks for watching CNBC on YouTube.